Hey guys, how are you? This is your host, Yishai Breslauer, with the CRE SharkEye Show, where we talk commercial real estate. And we talk today, we're going to talk about industrial. And you've seen some of the shows that we talk industrial. Today we have a treat. We have Tom McCrossin, and he's the owner, the president, the CEO of New Lane Management that focuses on industrial and storage. And that's what we're going to discuss today. Tom, thank you so much for being on the show. Really appreciate your time.
Absolutely. Thanks for having me. I'm looking forward to talking about industrial, warehouse, real estate, life,
Oh my gosh, we're going to have a lot of fun today. Buckle up. It's going to be fun. Okay, Absolutely. So here's what we're going to do. Before we dwell into how you got into it and we get excited about your past and inspire everybody that's listening to the show, tell us just, what we call the short elevator pitch of what you guys do today. What do you do in your business today? What type of deals you go into? Go.
Our main focus is buying industrial warehouses in the larger square footage, no less than 15,000 square feet, with the opportunity to subdivide. So creating smaller square footage footprints with the key basis of developing tight-knit relationships with those tenants. So as they grow their business, they can actually acquire more of the square footage in the building. Because the one thing I found in my short time in this industry is that, nobody wants to move. No commercial enterprise wants to move sites.
Exactly.
So if we can create a space that they can grow into, and so some of those smaller tenants may come and go. So as they go, we now have a key player on the site, on the asset, that can grow into the building. So because we've already set the expectation on the front end of a higher dollar per square foot, we're finding that we can continue to maintain that expectation as they take on more square footage. Now, is there a point in time down the road where we'll renegotiate and come down to a lower? Probably. But in the short term, we're going to capture as high dollar revenue as we can, which forces our appreciation.
First of all, it sounds very interesting. And you just gave me you gave me material for like 3 hours to talk about. So that sounds awesome already. But let's go back.
I remember being in a clubhouse room with somebody out of Los Angeles. And I said, we'll buy large buildings and subdivide. And she calls me out as being the biggest idiot in the room. And actually has become one of my closest operators that I divulge back to and be like, hey, I got this scenario. How would you handle it? Yeah. So getting called out, I think, is the, helps you learn. Not been in it very long, but.
And give out from your experience. That's 100%. Tell me something, Tom. How did you get into this whole thing called real estate? Before even we get into industrial, we'll talk about that too. But how did you get into it?
I started, graduated high school. My mother was a realtor, said, hey, there's a condominium for sale. I never went to college. I went straight into the working world, and it was afforded an opportunity to buy a condo, 2-bedroom, 2-bath, cost $450 a month with condo fee and debt service. Find me a 2-bedroom, 2-bath apartment that's not Class D apartments. That outside of Milwaukee, Wisconsin. From there, in the crash of 06, when the world started to turn upside down, took 9 months to sell, moved into a first apartment I ever rented was only for 7 months. From there, got married in 2010 and bought my first duplex with my wife, and we started building on the duplex portfolio. We had W-2 income and thought, hey, let's buy some more real estate and offset our income. Then found out that we made too much money and couldn't take the losses any longer. And long story short, a friend of mine said, hey, Tom, I need to buy an industrial warehouse. I'd really like the opportunity to partner with you. Hadn't really thought about.
Which year was that, by the way?
2019. So from 2010 to 2019, we started small and never really operated like a business, just trying to eliminate tax liability. 2019, we bought our industrial building. So my partner runs an electrical contracting business. He needed warehouse space. He had some connections with some other businesses. So we bought a vacant building, subdivided it, and it kind of formulated the recipe that I'm using today, which is to buy bigger buildings, subdivide, bring the tenants with us rather than using a commercial broker to lease it up.
Well, it sounds really exciting, but you know what's more exciting than that? The exciting part is, that's why I asked you which year you got in, is that you got into something, you got into a whole asset class that you probably didn't, I don't know if you knew, but
No.
just 2 years later became an explosion in the commercial real estate market that everybody's running into. Everybody's running into industrial. It's something exciting. Everybody wants to go into it. So that's great that you got into it.
I have the philosophy, jump in 2 feet first, figure it out as you go. It's probably a riskier move. It gives me a ton of opportunity because I'm not over analyzing. I'm the most non-analytical person you'll probably ever meet. Analyzing real estate deals. Kind of ironic, right? But in the grand scheme of it, as you acquire real estate, whether it's multifamily or industrial, you kind of start to learn through the process, hey, that works or that doesn't. And so it creates the baseline as we're analyzing future deals. Hey, on that first one that we had no clue what we were doing, where are we standing? Well, we took a $1.2 million asset and it's today worth $2 million at an 8 cap. So in 2 years, I've created more equity than I probably had revenue, W-2 income in 5 years.
That's amazing. So let's walk us through a little bit. Sorry, I'm stopping you because I want to really learn, how do you say, get everybody to learn the process, at least from your experience. So let's go into it a little bit. You know what's happening in the world. We don't have to repeat that. Amazon took over. Retail became industrial, literally, because all those shops that everybody used to love and go to remained as strip malls or shopping centers that provide basically restaurants or Dollar General and the likes.
Yep.
But all the rest became warehouses and became storage places and became industrial, facilities, properties, whatever. Here's the big question, okay? When did you see, before we get into how you find a deal and how you get into a deal, but when did you see, oh my gosh, the market is going towards my way and here's the opportunity and I can take over this and I can actually capitalize on that? When did you see that?
I don't know if I ever thought about where am I going to capitalize on it. I looked at it from a passionate standpoint. A coworker once said, "What do you do for a hobby?" And I said, "I build." And he said, "No, what do you do for a hobby?" I said, "I build." Because at the time I was a restoration estimator for insurance claims, fire, water loss. And we would write estimates all day during the day. And I'd go home at night with my wife and we'd work on our duplexes. And so it literally, I built during the day for others and I built for myself at night. And from there, the creative side of taking that vacant building in 2019 and subdividing it and bringing the tenants in and creating this, creative opportunity really spurred the passion to say, let's go do it again. And when I say I didn't really look at the economy at scale or what else is happening in the world, I jumped in 2 feet and said, let's do this again. I would say that in 2020, we put a brakes on it. I looked at opportunities, but I wasn't so sure where the economy was going to go. Didn't really have any mentors that I could refer back to and say, hey, what's your thought on this? Here we are on this podcast, expanding my reach, expanding my network, making people aware of who I am here in Milwaukee, Wisconsin. And 2021 exploded. It was like a light switch went off, got turned on January 2nd, and we just started hammering the pavement looking for opportunities. And that really has spurred a lot of growth and challenges. I don't know in 2019 when I went full-time real estate investor, how hard it would be to find deals. I think we all go out and say, let's go shopping, and it's really easy to spend money. But on the flip side, when you're an investor and you're analyzing and you need to hit returns and make your investors happy, it completely changes the game. And the sales skills that I created in my life have come full circle. I don't think sales was ever a skill set that I was passionate about, but damn, am I glad I had sales experience as I go through this career change.
100%. Tell me something. Let's walk through a deal, a typical deal that you're going into. You don't have to disclose a specific one. If you want to, you can. But how do you find them? How do you start up? You say location-wise, market-wise, size, as you already have mentioned, capitalization. Where do you find the capital? What do you do with it, et cetera, et cetera, et cetera? If you could walk us through and educate us about this process of the industrial market.
So if you go back to the comments I made about sales, so one of the sales tactics is tell everybody who you are and what you do. And I literally took that philosophy starting in 2019 when I said, I'm going to be a full-time real estate investor. I'm going to tell everybody I know. So I picked up the phone and I started texting and calling my contact list, which probably exceeded 1,000 contacts back in 2019, just from experience of life. You just accumulate contacts. Did all 1,000 even care? Probably not. But there were contacts made that, it goes to the marketing side of things of just continuously pushing your message and your brand in front of them. So it led me to meeting a couple of commercial brokers here in Milwaukee, Wisconsin. And I gave them the sales pitch of, hey, here I am, Tom McCrossin. I run New Lane Management. We're focused on industrial warehouses, and I'm looking for any size building, 15,000 square feet, no less than 2 acres. And those two requirements were kind of created based on the very first deal we did, which we didn't have any requirements when we bought our first deal. The need at that time was, let's buy a warehouse. We have these tenants. We fell into this vacant building that we could easily subdivide. And from there, I started to now look back at what that deal was and what have I learned and what red flags should have deemed a concern, and let's walk away from it. But we didn't know what we.
What are, for example, what are red flags? First of all, you're talking about a 15,000 square footage, which is much smaller than what you do today, obviously. But at that time, when you got into that type of deal, what were the red flags that today you would tell yourself, Tom of 2019, don't do it?
I think one of the red flags was understand the environmental impact of a phase one. We bought this building with the notion that there was ground contamination from the neighbor to the north. The DNR had flagged it back in the 90s. There was contamination cleanup. We haven't had to incur any costs dealing with that. However, I think those life experiences as you go into it deem things to be aware of as you do future deals. The thing with this property was that these tenants that we had in our back pocket, had we walked away from the deal, we would have lost the tenants. And one of the tenants is a national corporation. One of our first large tenant was a corporate back lease. I really look back and go, we never even verified income. We never verified documentation from these tenants. We just, based on relationships, said, sure, we'll lease to you. That's another thing that I've learned in the last 24 months, because actually coming up on June 15th will be a 2-year anniversary of being in the industrial space. But when we go back to look at the environmental impact of a site, what is going to cause us to incur cost of an issue? And the two things that come to mind on that very first site that we bought, is it going to be in a position that down the road, the city is going to deem that area a redevelopment site? Meaning, are we going to have to scrape it, and can we sell the land for better use into multifamily? or having to create a school. Those are two things that this site would never allow to happen. So what is the concern there? The concern would be that if the surrounding property becomes development and our site is a contaminated site, we basically have lost everything, right? Because we'll never be able to afford the dollars to clean up the site to the position that we could sell it off to a developer, because no developer is going to want to take on a contaminated site when, as it sits today from an investment standpoint, we could sell it for $2 million and we probably should walk away. But the cash flow is there, and we're just going to continue on utilizing it as an industrial site. So red flag for me is anytime there's environmental impact through the phase one reporting, understanding as to where are we going to take that site and how can we eliminate the exit strategy so that we don't get the burr of the cost to have to clean it up to create more value.
So here's the question, you emphasize phase one. Did you, meaning at that first property that you got, did you do a phase one? You had a phase one?
Yep. We did a phase one. The seller had a phase one from 1996. Our banker suggested that we should do a new one just to verify nothing has changed. Did I understand what a phase one was in 2019? Absolutely not.
Right.
I think due to the fact that we didn't understand what it meant, we continued to refer back to legal counsel for an opinion on the environmental impact, at which point the attorneys for us that we had hired continuously recommended that we walk away. Do not buy the site. Do not incur any liability. The minute you buy it, you now own, you're aware of it. I think we all, in commercial real estate, when you're aware of an issue on a property, it's now your bear to be open about it. So by us paying for the phase one, we know what the baseline is when we acquired it in 2019. So if something changes in 2025 when we sell it, or 2023 or 2022 or whenever we sell it, that's the baseline to what it was when we sell it is going to be our responsibility to deal with it. However, the only way that I see something changing, and I'm sure there's viewers out or listeners to your podcast that'll be like, wow, this guy, he either knows his stuff or he's really naive. I would go on the side of naive because I'm a guy that jumps in 2 feet first and figures it out. Sometimes it's going to come back and bite me in the rear because it's going to cost me money to learn. There's two ways to learn. You either pay for training or you learn in the field. I'm a guy that likes to learn in the field rather than paying someone to teach me, because you still don't. If someone taught me everything I know today, it's probably 10% of what I retained, right? Because when you incur the experience and it hurts the pocketbook, you're going to remember that for a long, long time.
Tell me something. How do you choose the location when you talk to the brokers and an area? First of all, do you operate in Wisconsin where you guys are?
So another criteria that I have is we only buy in our backyard currently. So I'm located in Milwaukee, Wisconsin. Smart. And the market that we buy is only in Wisconsin. I'll go to northern Wisconsin. I'll go to southern Wisconsin. I'll go to western Wisconsin. Currently, everything's within 30 minutes of where I live because I also manage everything we acquire.
But what are the rules? Sorry, I'm stopping you, but this is important. What are the rules in terms of location for industrial? What is a no-no in terms of the location?
That I'm not going to be able to give you an answer because I don't really follow rules. I create what I want and we go with it. Some of our
so how do you decide? It's a fair answer, but how do you decide? For example, a broker, you have the relationship with the broker, and the broker comes to you and he says, "Okay, I have this industrial, I have this building. It's let's say 100,000 square foot. Okay." What will make you either take it or lose it? Meaning we understand the whole idea of the contamination phase one, etc. Sure. But in terms of a deal, on the deal level, what will get you to say, I love the deal?
Actually, there was 100,000 square foot building I had looked at probably 3 months ago. It got listed for $4.5 million, which puts you about $45 a square foot. So one of the things in Wisconsin I found amongst talking to other industrial operators is that we're still buying significantly under the cost of construction. So if you were to build a 100,000 square foot building, you're probably 125 to maybe $150 a square foot. Now,
Correct.
there's a lot of variables that go into that, but let's just start with that baseline. So if I'm looking at a 100,000 square foot building that we're picking up for $50 or $45 or less, that's a pretty good opportunity, because our first deal we bought at $65 a square foot with no revenue. So based on that, red flag for me is that anytime we have to create equity, or create value, that's the equity that we should earn, not the seller that has the property. So this 100,000 square foot selling for $4.5 million, essentially it was like a 7 cap, but the tenant vacates at the end of September of 2021 or 2022. It was like 2 years or less of the lease term. They were a third-party logistic company.
That's a challenge.
They were abusing the building.
So how did you deal with that?
The value that I saw is that we could acquire it as a 7 cap with the notion that their average triple net lease fee was only $2 a square foot. Our market rate in Milwaukee, Wisconsin is between $4 and $4.50. So just based on that, being able to qualify for the debt, so the bank is going to look at us like, okay, what is Tom McCrossin's experience in industrial? He's got 3 deals done. He's taken buildings that are 50% vacant and he's leased them up, and now we're at 100%. So instead of being 80% loan to value, we're really right around 60 or 65% loan to value, because we're forcing that appreciation. So going back to this 100,000 square foot building, I wouldn't buy it at $4.5 million. We started our offer at $3 million, knowing that we were going to get to a $4.5 or $5 million valuation once we stabilize the asset. What do I mean by stabilize? It means getting a long-term lease. And in order to do that, we were going to separate the building into 3 tenant spaces, roughly about 33,000 square feet apiece. The building was also set up that it has dock and drive-in door divided in thirds. So it was actually a building that started, let's call it 25,000 square feet, and then they added another addition, and then they added another addition. So the site was like 2.5 acres, sitting with a 100,000 square foot building. Another red flag for me is there's really no outside area around this building. It's set up for logistics, trucks in, trucks out, very few employees. Even though the building had a 12,000 square foot office, our play was to also take out probably half the office space and create more warehouse, because we did want to separate it into thirds, which would then maximize our revenue to about $5.50 or $6 a square foot triple net is what we would analyze to get it leased up.
So I'll tell you what, so many exciting things you're talking about. And now I want to ask you, okay, you divided it to 33,000
Yep.
square foot approximately. You know what we say in retail that, and I'm not a big retail guy, it's not my big thing, but it's a known thing in retail that the main part of having good tenants is to have relationships. That's why they have the ICSC, they go to those conferences to meet all the nationals, and then you have to know the locals, moms and pops, and to know the right brokers, et cetera, et cetera, et cetera, in order to have the right tenants. How is it in the industrial? How do you create relationship? Who are your tenants, your favorite types of tenants, and how do you find them?
I don't know if I have a favorite type of tenant currently, because we've only been in it for 2 years. We currently sit at about 47,000 square feet under management. We do have a deal in the pipeline that will take us up to about 150,000 square feet under management before the end of the year, with other opportunities throughout there there's still 6 months left of the year, so there's still plenty of opportunity. But I continue to look back at who are our current tenants and which of those tenants are business industries that we should continue to formulate connections with. So we have tenants that are very construction focused. We have tenants that are very printer focused, and we have miscellaneous tenants. Somebody that doesn't fit a specific industry that that's repeatable. So I think to really answer that question, we're still trying to figure out who are those tenants that we should go after. But the relationship based is continuously talking to brokers. So I'm not anti-leasing through a broker. However, there's value that a broker can bring, because every day they're out there doing cold calls. They're out there every day talking to their tenants that they have relationships with. And that's value that brings it to me, because I don't have to go and do that. I have no interest to go door to door to create those relationships. I can say that when we acquire a new building, I do physically go neighbor to neighbor to introduce that, hey, I'm the guy that just bought the building down the street. Do you or any of your contacts interested in renting more space? And so I will continue those conversations, because I think a business that's expanding to know that the neighboring building 2 or 3 buildings away has vacancy is something that they would have never learned had I not knocked on their door.
You got to do the legwork, as we call that.
Correct. You got to do the legwork. You got to introduce. You got to start the relationship somewhere. And so from there, I take their information and I enter it in our database. So as we continuously grow, there's marketing that's being created to be sent out. Does that answer your question?
It's a beautiful answer. I love that answer. Now let's go for a second to the aspect of financing. Okay, you said before 60% LTV. In some cases it's like this, like that. Give us in general, what is a custom and industrial, at least from your end, when you talk to lenders? What are their criteria how do they talk to you? How do they approach you? What are their requirements when they come to you, and what are they willing to give you?
I think it's a difficult conversation that gets started, because when you start in the industrial space, let's talk my very first deal. I didn't talk to any lenders. My partner said, hey, I got this banker, my personal financial planner referred me to this banker. He's going to finance us a non-recourse note. It's a $1.2 million buy. We have to come to the table with 20% down. So I guess going back to one of your other questions is, what is a red flag? We should have come with more money to the table than just the 20% down. Because I can tell you that we utilized cash flow to renovate this building, and we were very struggling for the first 9 months. The bank balance was, $1,000 at best.
Right, and that makes it very difficult. But
it makes it difficult.
But that was then. That was that time in the beginning, right? Yep. 2 years we're not 20, but still 2 years is a lot. Meaning 2 years are a lot, and especially if you got to your third property, you have much more experience today. What would be today the thing that you would go after, and what are the lenders telling you today when you go to them?
So we have a deal in the pipeline, and I just started conversation with about 6 different lenders, and I don't like to waste people's time. So I basically say, hey, we got a deal. We're buying it for X dollars. Our NOI is X dollars. I'm looking for 80% loan to value with 20 or 25 year amortization. And I've gotten some bankers that come back and say, well, we wouldn't do anything for less than 75% loan to value, but we can get a better interest rate the higher equity down payment that you bring to the table. So then I go back to my analysis spreadsheet and go, okay, so if we have to bring more cash, there's more capital at play. It limits us from using that capital for the next deal. So how much capital, my philosophy is I want to bring as little capital to the bank as possible. So how do we do that? By doing an 80% loan to value. It creates a little more risk because we have a little less equity in the deal. However, when we're forcing the appreciation, we're forcing the value, we're getting that 80% loan to value to be more in the 55 to 65% when we're stabilized. So the sooner we can get there, the better the deal looks. And so when the bank recalculates the debt coverage service ratio, now all of a sudden we're looking at 2 and 2.5%, 2.5 times rather than our minimum requirement of 1.2.
So sorry for stopping you, but here's the question. According to everything that you said right now, So there's if I understood correctly, I don't know if I understood correctly, there's a refi after you guys go and do the CapEx, as we call it. You go and
Sure.
put some money into it, right? Is that correct?
We haven't done any refis on the short term. I
So how,
think
so it gets from 80% to 55%, how?
just based on the valuation
The
of the
value,
deal,
pure
the value, we're not having to refi it and showing that we're at a 65% loan to value. I just know that even though we took the money at an 80% loan to value, or I should say 80% loan to cost, because the value
You got it.
is going to skyrocket once we start adding revenue, or getting triple net leases in play with longer term leases changes the risk factor. So we buy it at the 80% loan to cost, and that's probably a better way to explain it. At the end of the day, that loan value becomes a 65 or less percentage of the value of the asset.
It's really exciting. Tell me something. What is your strategy in terms of when you go into a deal? Are you a buy and hold type of guy, or are you looking at the exit very soon? You want to see the end. What type of guy are you?
I definitely love the buy and hold mentality, because if you end up overspending on your capital expenditures, or you overspend on your tenant build out, you're going to recoup the money. Now, if you buy today and all of a sudden in 6 months, the world goes crazy and we lose revenue, but we're still maintaining our debt coverage service ratio and we're still maintaining space for tenants, we're okay to have a lower valuation of the deal because we're in the long-term hold pattern.
As long as you get your NOI, as long as you're paying your debt service, you're getting your rent, you're getting everything, you're fine. That's your approach.
That's my methodology, and that's a conversation I have with my investor partners is, hey, here's our pro forma, but if something goes awry and in 4 years we're at 50% of the revenue, but we're still maintaining our debt service, we're still gaining equity, and you don't need your cash back today, you're still going to get a cash return. It's just going to be it's still above 6% on their money that was invested in year one.
Mm-hmm.
Instead of forecasting and showing that we're up to 12% cash on average, if they got 50% of that, they're still ahead of where they were if their funds were in the stock market and it plunged 45%. There's still value being created. It's just not as lucrative. And I think that as investors understand that it goes up and down, and not everything is what the spreadsheet says, and you can have those real conversations and you're building those relationships with the financial partners, there should be little frustration and anger. Now, is everybody going to be happy every day that something doesn't go right? Absolutely not. But if we can continue to maintain our debt service and maintain expenses and pay all the bills, there's just less cash in a time frame where values come down. We're going to get that money back. It's just in the buy and hold strategy. We're going to get the value and the dollars back on a longer term. So instead of planning to sell it at 5 years, maybe we have to hold it for 10. But that conversation needs to be had with those investors in the front end rather than in the middle of it going south. I haven't had any deals go south. I don't have that many deals in the pipeline, but I think it comes back to your ambition and your tenacity of how are you going to jump through these hoops and how are you going to create more value for everybody involved. So one of the things that I do as we're creating that track record is continuously having conversation with the investors that are partners on the deals. So I don't currently sign everything as myself. We're not set up as a GP-LP partnership. We're all partners on the note together. So none of my deals have more than 3 guys involved, and I like to keep it that way. It keeps conversation light. It's not so serious, and most of the time the other investors know each other, and I'm the guy that's putting them together. Or they're the guy that's inviting me into an opportunity and saying, hey, Tom, we have some money. I understand you're doing some commercial real estate. We really would like to learn more. And so the conversation spurs that way.
So first of all, it's very interesting, and it's very, I would say, out of the ordinary, as you call, when it comes to real estate, because everybody else is doing this GPLP structure, right?
Mhm.
Raising capital, coming to everybody and other people's money and all that stuff, and taking fees, et cetera, et cetera. But in your case, and if I understood correctly, everybody signs the loan together.
Yep.
And everybody splits, together.
Correct.
And that sounds like a more, I would say, old school type of a way. And
Yep. I think one of the things that
Yeah.
now it is unique in the sense that I bring very little cash to the table. So I'm gaining equity and I'm gaining value by bringing the deals that these investors wouldn't, they're doctors, they're lawyers, they're other business owners. So they don't have the time to create the value in the deal, but they have a ton of life experience in whether they're, 30 years as an attorney or 20 years as a doctor,
Right.
there's a ton of value that they bring back to me of just looking at other real estate deals. So we have one in the pipeline, and one of the investors buys and sells businesses, and he doesn't have a ton of real estate, but he's got a ton of experience in buying and selling businesses, which every building out there could be a business, right? So from an investment standpoint, every building has a story, every business has a story. There's going to be good years and there's going to be bad years. And so with the experience of him buying and selling businesses, that's a tremendous value add play to have in the partnership, because he knows so many more people and so many more businesses. And so if we get a tenant that is suffering, we can bring him to the table and see, hey, how can we help you, Mr. Tenant? Is there things that we can bring from the landlord side to this tenant? Because it becomes a win-win. It helps the tenant succeed, and it also guarantees that we'll get our rent, right? So if we just let a tenant come into our building and didn't care what they do or how they do it or what challenges they're having, I'm taking it a step further and really trying to understand who their clientele is, so we can help them from a business standpoint as well. Now, are we paid consultants? Absolutely not. We're still real estate. I'm still a real estate investor through and through, but I feel very strongly that we need to know our tenants inside and out. And that's something in the commercial real estate world that I just don't see happening very regularly. And that probably comes from my mentality of dealing with our duplex rental portfolio, of understanding our renters. That same methodology and that same conversation and the relationship is going to these business tenants. Now, are some of those business tenants not as open in the beginning? Absolutely. But over time, they're starting to open up. They're starting to have those really deep dive conversations of what other challenges are. And it's not me trying to understand, like, how are we going to get this tenant out? What's going south in their business? It's really coming back to, I want them to succeed because it helps me succeed.
Right.
So another philosophy I have is we buy buildings for tenant needs, which is a completely unique strategy.
I love that strategy, and it's a great tip for everybody who's listening.
Because if those tenants are growing, they're going to help us grow the portfolio. We'll go buy another building. I have the means, I have the connections. I know we can go find the money from an investor pool to go buy another building when the recipe makes economical sense, meaning vacant, fill it with revenue. Now our value just skyrocketed, and everybody in that scenario wins.
Tell me something. Where the philosophy when it comes to commercial real estate, one of the biggest philosophies is build a team. Can you tell us a little bit about your team aspect? Who is around you, and what type of team you're using? I'm not only talking about in-house. I'm talking about the whole in-house and outsource.
Sure.
Who are you using? If you could walk us through a little bit about
So I would say the three top people in my team are the legal counsel attorney, who has connected with me a ton of different real estate focused investor people. My insurance agent has, you got to have your insurance in line across the board, and your accountant. Those three are probably the top people I talk to on a daily basis. And the next tier of guys are the commercial real estate brokers. that I'm talking to on a daily basis. There's probably 4 brokerage firms here in Milwaukee, Wisconsin that I deal with on a daily basis. And it's really trying to help them understand like the value that they each can create for me is going to be a win back to them, because we're going to continue to buy, because each one of those commercial brokers knows a different group of people, and each group has a different value. And so as we grow, our 5-year goal is 1 million square feet, which going from duplex rentals to industrial warehouses, a large jump. But right now we're on track to do 250,000 square feet of acquisition in 2021, which was 0 in 2020.
It's so interesting. What I wanted to tell you is, you just mentioned before that you're going into a new property and you have a lot of work, right? You have a bunch of stuff, you have to do divisions, etc. So part of your team is also GC, or meaning, tell us a little bit how you do that. You take a CM, a construction management company, or you do it an open book style. You take a GC that does it turnkey. What do you do?
I try to do it all myself, which is going to get me into a lot of trouble because there's just only so many hours in the day. And I think one of the focuses I have is that working for myself, you stop working at 4:30. I think as entrepreneurs, there's always work to be had. There's always deals to be had. There's always things to be done, 24/7. Now, is that really the lifestyle that everybody really wants? Is to have to wake up at 6 or 7 in the morning, start replying to emails, and the next thing you know, it's 11 o'clock at night, and you didn't get nearly half done what you wanted to because the deals keep coming, the phone calls keep coming. I think we've all been in a position where the phone just never stops and you're ready to just throw it away. And if it's really that important, someone will call back again. Like, there's a ton of different phone calls, and a lot of that goes back to just staying focused on what you want to accomplish that day. But for me, focus is number one is family. And in my past life, my past career, it was working all the time for someone else. And so now that I have the opportunity to work for myself and create value for the investors and create value for these buildings, it doesn't need to happen all the time. You don't continuously have to work until 11 o'clock at night. Now, leading up to closing, sure, there's probably 5 nights in a row that you're trying to get paperwork. You're trying
exactly.
to
That's what it's exactly what I always say to people. I tell them exactly that. I tell them, listen, if you get into real estate, it's not one of those things that you have to work from day to night, et cetera, et cetera. But when it comes to, and sometimes it's, it's sort of mellow. Sometimes it's a laid back type of a thing. But when it comes to a closing, you have to be able to not sleep for a few days until you're done. That's how it works in real estate. That's how it is.
Yeah. So you lead up to the closing, working a ton of hours, and then after acquisition, now you're trying to get all those tenants into your property management database, because one of the other things that we do is that we manage everything we own. So we'll never do third-party property management, but part of the expenses on the asset is that someone has to be paid for management. So we might as well get paid for management as part of our company structure.
And the construction you do yourself?
And the construction we do ourselves. So I also project manage the tenant build-outs. So hiring the architect, hiring the electrician, hiring the plumber, the sprinkler contractor, drywaller, paint, the trades that need to be done for the tenant improvements, we control in-house as well. Now, are those employees at this point? No. But part of our long-term plan is that we have enough projects happening that we can bring that stuff in-house. And the value provided back to the buildings is that we're decreasing the amount of cash that we need to spend to do these tenant improvements, which all goes back to the numbers, all goes back to the analysts, analysis on our performance. So instead of paying a construction management company, we're handling it in-house and we're creating the value back to the building. And so as we grow, we will add a property manager, project manager. It's just inevitable. I can't continue to do it all, but I will do it until we're up to about 250,000 square feet. So if we do hit our numbers this year, that'll be a 2022 hire.
We learned a lot today. We learned a lot. We covered a lot today. And I love the one thing that your philosophies are very similar to mine. So I love that part. I love that part. And your work ethic, I think, is something that everybody should learn from. The fact that you come to where you are, or you came to where you are today, is because you have that work ethic, is because that you have that compass to go and move forward and to do the right thing and to get to know your tenants and to have the basics, to buy low, to maintain the right financing, to maintain the right cost of, how do you say, the whole LTV aspect, the whole LTV philosophy that you are carrying with yourself is actually making your business and a cash flow machine that works really well. And that is an exciting thing.
I think another thing that can be taken away or shared is the bank shouldn't be looked as just another vendor. Just like Uncle Sam in the United States is a partner, whether we all know it or not.
Exactly.
He gets a cut of whatever is created for tax liability, right? So the bank really should become one of your partners and one of your teammates, because a good banker will look out for you, and a bad banker isn't going to care what happens after closing. For us here in Milwaukee, Wisconsin, it's the small local banks that I'm creating those relationships with. Currently utilizing one bank. However, we know that as we grow, that one bank isn't going to be able to maintain the debt to 1 million square feet in buildings. The other thing you had asked about markets earlier in our conversation, I've talked to other investors across the country, and other opportunities have come to me because there's just not that many of us industrial investors that are operating, right? Like there's a ton of investors out there who would want to invest in the industrial space, but there's not, you can go into I would say this, you go into a real estate meetup and you ask, what asset class are you buying? And I'd be willing to bet that 9 times out of 10, it's going to be multifamily or
100%.
Residential. I've yet to go to a meetup here in Wisconsin that I bump into another guy that is buying industrial focused. There's some guys that are buying industrial. There's some guys that are there's some guys buying multifamily. And when there's not enough multifamily deals, they're now buying a retail deal, and they're buying an industrial deal, and they're buying, a medical facility. They're all over the map. But for me, I buy strictly industrial warehouses. And because of that, we're creating those systems and the value and really understanding that asset 100%.
I love that focus. I love that.
But
focus.
the other parts of the country are buying deals where it's costing $150 or $200 a square foot for acquisition. And I have a hard time seeing value in buying a deal in Houston, Texas that would be $15 million for a 50,000 square foot building, where if I took that same capital call and 15 million, we could buy a 200,000 square feet here in Wisconsin. And because of that, the revenues in Houston are probably higher to justify the higher value of the property, but there's a lot more headache that comes with a higher value. And so if you can bring that cost of buildings down and still generate a ton of revenue, then you can actually have a better return and less risk. And I'm all about the less risk. And so I strictly buy in Wisconsin. I'm not opposed to coming outside the state of Wisconsin, but when you analyze like what is the dollar required and where are we at, and if you're at an 8 cap, but here in Wisconsin we can buy at a 10 cap, well, why would I go buy an 8 cap? Especially on the other challenge that it's 500 or 1,000 miles away.
Which is a crazy thing, but I love that local philosophy. Basically, that's how you start the best. You get to know everything. You get to do the legwork and get to know your tenants and get to know the people you work with, the brokers, everyone around, the lenders, as you've mentioned. Love that. I'll tell you something. This was great. I really enjoyed it. I just want to tell you guys,
Yep.
I hope you guys learned so much and you enjoyed it as much as I have. Thank you so much, Tom, for being with us. Really appreciate that. And you guys, check out the industrial. Check out the industrial asset class. It's exciting. It's something to learn about. Why? Because the world is changing and it's a big deal. You guys, take care. I'll see you in the next show.